Hello friends, very good evening. Welcome to the Hindu editorial analysis line by line. The title of today's editorial is A Matter of Import. The catch is here. The meaning of import is not the one you are thinking. The meaning of import here is something of importance, which means import as a noun. The meaning of the word is importance here. A matter of importance. That's the meaning of this particular word. That is the meaning of this particular sentence. So that is the meaning of this particular word. So this editorial is about current account deficit, trade deficit, and all those things which are related to external sector. So before getting into this editorial, I would like to give you some background knowledge that is related to this particular editorial. After understanding the background, let's get into the editorial and go line by line. Okay? Yes. So look at this particular document. This has been sourced from Economic Survey 21-22 from the chapter called External Sector. From the chapter called External Sector. The title of this particular table is Major Components of India's Balance of Payments, and there are several items here. So let me teach you what is this concept of balance of payments. So let's assume this square or rectangle is India and this circle is rest of the world. Okay, this is rest of the world. Now whenever there are some transactions between India and the rest of the world, money flows either from India to the rest of the world or moves from rest of the world to India. Very, very important. For example, whenever India is exporting some goods, let's say when India exports mangoes, what happens when India exports mangoes to United States of America? United States of America is buying those mangoes, so the money will come to India. So goods are being exported, goods are moving out of India, and the money is coming into India. Money is coming into India. So look at this. Whenever you are exporting something, the money flow is towards the country. The money flow is towards the country. Whenever the money flow is towards the country, we notate it using positive sign. So exports are given positive sign because the money is coming into India. Now let's take the case of imports. If India is importing oil from Iran, let's assume, if India is importing oil from Iran, so what is happening? India has to pay money to Iran. India has to pay money to Iran, which means the oil is coming into India and the money is flowing out of India. So whenever an import transaction is happening, the money is going out of India. So we give negative notation to that. So imports are given negative notation because the money is flowing out, whereas in exports we give positive notation because money is coming in. Similarly, when a foreign company comes to India and invests, if they invest in Indian stock market or Indian bond market, or if they are setting up a new business, what happens? The money comes from the foreign company to India. So it is a positive transaction because the money is coming in. Similarly, when an Indian goes to any of the foreign country and he establishes a business there, the money is going out. When India takes a loan from World Bank, money is coming in. When India is taking money, when India is taking loan from World Bank, the money is coming in. But when India pays interest on the same loan, the money is going out. The only thing that you need to remember is there are many transactions that happen between our country and rest of the world. If in a transaction the money goes or money moves into the country, it is a positive transaction. If the money moves out of the country, it's a negative transaction, right? So we have to add up all positives. Let's call it A. and we have to add up all negatives wherein the money is going out. Let's call it B. When you add A and B, B is negative, A is positive. If this is positive, what does it mean? There is more money coming into the country than the money that is going out of the country, which means A is greater than B. A is greater than B. If A plus B is negative, that means the more money is going out of the country than the money that is coming inside the country, right? So together, all positives and negatives together, we call it balance of payments. If it is positive, we say balance of payments is positive. If it is negative, we say balance of payments is negative. So everything is there in that sentence itself, that word itself, balance of payments. You are looking at all the payments that India is making to the rest of the world, which are negative, and all the payments the rest of the world is making to India, which is positive. When you sum up both of them, you will get the balance. You will get the balance. You understood what balance of payments is now? Yes. Who tracks all these transactions? It's the RBI, or the Reserve Bank of India, or the central bank of a country. It records all these transactions, right? All the money that is going out of the country and all the money that is coming into the country. So in this balance of payment statement, there are predominantly two major heads. One is your current account. The other one is your capital account. Very, very important. Current account and capital account. I will give you a simple tip to remember what comes under current account and what comes under capital account. Always remember, current account, equate it with something like short term. Transactions which are settled instantly, transactions which are done with very short span of time. For example, whenever you are sending mangoes to an external country, you get payment quickly, right? Either immediately or maybe in 1 month. It's a short term transaction. Whenever you are importing something, again you will have to make payment immediately or in some time, again a short term transaction. So all the exports and imports come under current account because they are short term transactions, right? Similarly, services. If you take services, for example, like software services, an Indian software company based out of Bangalore is delivering software services to a company based out of US. So we are exporting services here. Again, the transaction gets settled immediately. So they take a project, they do it, and they get payments immediately. So services also come under current account. And there is another component called transfers. What is the meaning of this word transfers? So pay attention here, right? Let's say there are a student, okay, who studied in US and got job in US. His parents are in India. A person working in US and his parents are in India. This person from US is sending money. This person from US these are parents, and this person is sending money to his parents. He is in US. Now the money is flowing in, and it is a short-term transaction because the money comes immediately, right? There is no long-termness to this particular transaction. So it is a transaction under current account. For example, the same parents are sending money to the student who is studying in US. He is not working there. Let's say he is studying in US and they are sending money to him. Again, it comes under current account. If they are sending money, obviously it's a negative transaction because the money is going out. If he is sending money to his parents, it's a positive transaction because the money is coming in. Positive and negative depends upon whether the money is flowing out of the country from India to other countries or from other countries to India. That is positive and negative. Current and capital, it depends on the nature of the transaction, whether it is a short-term transaction or it's a long-term transaction. So we have looked at current account. And the final, income. What is the meaning of income? Let us say a foreign company establishes business in India and gets profit, and the profit goes out of the country. A foreign company comes to India, sets up business, they get some profit, and they take the money out of the country. So when they come to India and establish business, they are investing some amount. They are investing some amount into India. That money is coming into India. That money is coming into India. That is positive transaction. That is positive transaction. But this profit they are taking out of India. So this is a negative transaction. So whenever they get profit, they take it immediately. So it comes under current account. Unless the interest paid on loans, again current account. All these things come under current account. Right? So all these transactions, we have discussed transfers wherein remittances. Parents send money to children or children sending money to parents. Services we understood. Income, the interest income on loans or profit or dividends generated on investments. Right? All these things come under income. All these things are together put under invisibles, and this invisibles is under current account. So current account is broadly divided into two categories. One is merchandise trade balance, which is your goods, and the other one is invisibles. Invisible has three components: services, transfers, and income. Together, this A1 and A2 together we call it current account. When you come to capital account, I am not going to explain it in a detailed manner, but I will differentiate it from current account. Capital account will have all long-term transactions. For example, all foreign investments. When a foreign company comes to India and invests and sets up business, that comes under capital account, because whenever someone is setting up a business, they are coming up with a long-term intention. It's a long-term transaction. It's not that they set up business today and close tomorrow, right? It remains here. So that kind of investments are long-term. Or if India takes a loan from World Bank, obviously it's a long-term loan. They take a lot of time to repay it. All these long-term kind of things. See, loans, investments. Investments can be direct investments or portfolio investments. When a foreign company or foreign investor invests more than 10% of the company, right, then it will be foreign direct investment. If it is less than 10%, we call it foreign portfolio investment. So all these things we discuss when we discuss our external sector classes in Indian economy classes. But for now, I want you to understand the difference between current account and capital account. Current account and capital account. Current account transactions are predominantly short-term in nature, and capital account transactions are predominantly long-term in nature. For a country like India, current account generally almost always ends up in deficit, because we import more than we export, because of which we end up in current account deficit most of the times. But our capital account is mostly positive, because India is a developing country. Several multinational companies, they come to India, they invest in India. Because of huge investments that are coming in India, we generally have capital account surplus. If you look at this, in this thing, capital account, you see the number, it is positive. If you see current account, you see most of the time it is negative, except for few in 2021, except 2021 because of COVID, our imports got reduced. Otherwise, most of the time it is negative. It's almost always in deficit, right? When exports, if you look at goods now, within goods, if exports are more than imports, we have trade surplus, merchandise trade surplus. If imports are more than exports, we have trade deficit or merchandise trade deficit. Overall current account, if you have positive, we have current account surplus. Overall current account, if it is negative, we have current account deficit. When I say overall, it also includes invisibles. I hope you have understood some basics about current account and capital account. Now with this background, let's look at today's editorial. So again, the title says a matter of import or matter of importance. Now let's look at the next sentence. Spectre of wider trade and current account deficits is dragging the rupee down. What is the meaning of spectre? Spectre is something that is widely feared, something that we are fearful about, like a ghost, right? What is that something that we are fearful about? Spectre of wider trade and current account deficit. The deficit of trade as well as current account could be more in future. That's what we are fearing today, because imports are rising and exports are not rising as much, and the deficit is going up already, and we are fearful that it might go up even further. The deficit might go up even further in future, and that is the fear we have today, and that spectre is dragging the rupee down, because of which rupee is becoming weak day by day, So let's go through this one by one. India's monthly merchandise trade. Whenever you see the word merchandise, what is the meaning of this? Goods, not services. Merchandise trade deficit hit a fresh record of $25.6 billion in June, as per preliminary estimates released by the Commerce and Industry Ministry on Monday. Commerce and Industry Ministry released some estimates according to which merchandise trade deficit hit a record high, which means imports are much higher compared to exports. This is the third occasion in 7 months. It happened thrice in last 7 months and second month in a row, which means it happened in May as well and it happened in June as well, in a row. That the trade deficit has widened to all-time highs. In May also we hit all-time high, even in June we hit record high. In June, the value of outbound shipments, means all the exports, grew 16.8%, which means exports grew by 16.8%, marginally slower than the 20.6% growth recorded in May. In May, exports grew 20.6%. In June, exports grew 16.8%, which means marginally slower, to about $38 billion, which reflecting third successive month of moderation. What is the meaning of this? Every month exports are growing, but the growth rate is going down. If you look at May, the export growth rate is 20.6%, but in June it's 16.8%. Although it is positive, the growth rate has moderated. The rate of growth has moderated. Worryingly, 4 of India's top 10 export items, what are they? Engineering goods, cotton yarn, drugs and pharma and plastic products, contracted from a year ago. From a year ago, India's 4 out of top 10 export items contracted, which means the exports have gone down compared to last year. Petroleum product exports were up 98% from June 2021, but about $0.7 billion lower than May 2022. Very important point. Petroleum exports were up 98% from June 2021. Very important sentence. You might have a doubt. Sir, in India we have shortage of oil. We import oil. But why is he saying petroleum exports? When we don't have oil for ourselves, we import. How can we export petrol? Right? So you might have that doubt. That's not a bad doubt, that's a good doubt. Remember, India imports crude oil. We don't import petroleum. We import crude oil. And we have companies like Reliance Industries Limited, BPCL, HPCL, which are called refineries, oil refineries. These companies, once they import oil, they refine it. After refining, they produce products like kerosene, diesel, naphthalene oil, petrol, ATS, aviation, turbine, ATF fuel, the one used by all the flights, right? They use this kind of ATF. So all these kind of petroleum products are produced by our refineries, and there is a lot of demand for these petroleum products in the external countries, rest of the world. So all these refineries, what do? They export some of these petroleum products. So whenever you see this word petroleum exports, it is not crude oil, it is the refined products after refinement of crude oil. So these exports were up 98% from June 2021. Compared to last year 2021 June, the exports were up 98%. But about $0.7 billion lower than May 2022. Compared to May 2022, which means last month, the exports were slightly less. Even as exports growth slid, the growth of exports, what happened? It slid. The past tense for the verb slid, imports surged by over 51% to $63.6 billion in June. Surge means to suddenly rise or grow. Suddenly rise up. Imports have gone up by 51% to $63.6 billion. All the students who are attending or listening to this, I want you to make note of vocabulary as well. This is a unique editorial analysis that you will see nowhere in the country, wherein I will try to improve your vocabulary. I will try to improve your reading skills. I will also give background of each editorial. I will cover each concept in detail so that you will never ever forget in your life, and I will make sure you understand every word, everything, every concept that is written in this editorial. So imports surged by over 51% to $63.6 billion in June, crossing 60 billion mark for the fourth month in a row. Export growth slid, but import growth has gone up further. Coal imports up almost to 42% year on year, and petroleum inflows up 94.2. Here the meaning of petroleum is nothing but crude oil. Petroleum inflows have gone up, coal imports also have gone up. They drove nearly 3/4 of this surge. Why did imports go up? Because of predominantly two important factors. One is coal, the other one is petroleum products. We import a lot of coal, we import a lot of petrol, we also import gold. And although gold imports, generally the most imported item by India is crude oil followed by gold. But this time coal imports also dominated. Although gold imports, which had soared means again went up, just like surge, nearly 8-fold in May to touch 107 tons, moderated from over $6 billion that month to $2.6 billion in June. They were still 169% higher than a year ago, and significantly over April's imports of $1.7 billion. Imports of gold went up quite high in May. They went up by almost 8-fold, 8 times, to touch 107 tons. But in June, the imports have slightly gone down. But compared to last year June, they are still 169% higher. And even if you compare them to April's imports, they are still $1.7 billion higher. The trade deficit or merchandise trade deficit is same. The difference between import of goods and export of goods for Q1 adds up to a record $70.25 billion, over 2 times higher than a year ago. Trade deficit has gone up quite high compared to last year. Okay, trade deficit doesn't include invisibles, remember that. The tangible slowdown in exports due to weaker global demand is unlikely to change much soon. We are seeing slowdown in exports. What is the meaning of tangible? Tangible means something that we can experience, something that we can feel. The slowdown in exports is clearly seen, something we can easily feel it. Why? Due to weaker global demand. Why are exports going down? Because of weaker global demand. It is unlikely to change much soon. It is not going to change very soon. Why? With recessions and sharp growth slowdowns expected in several developed markets. In several of the developed markets, we are seeing recessions, means economic contractions, and are sharp growth slowdowns. Either the countries are going through recessions or they are going through growth slowdowns, which means their growth is going down. A country which used to grow 5% every year now is growing at 3% every year, which means there is a slowdown in growth, because of which the demand for exports has come down. Domestic demand for imports. We have looked at the export part. Now let's look at the import part. Domestic demand for imports of oil, fertilizers, coal, and even gold, which is a safe haven for investors amid tumultuous financial markets, is largely inelastic. Very, very important sentence. I want you to focus on certain words here. Look at this word gold, a safe haven. What is haven? Haven is something that offers protection. I will give you one example. Pakistan has become a haven for terrorists. Terrorists are getting protection in Pakistan. So that is how you need to understand this word haven. Safe haven means something that offers safe protection. What is that? Gold. To whom? For investors. When? Amid tumultuous financial markets. When financial markets are not doing great. What are financial markets? Your stock markets, your bond markets, all these things. When they are not doing great, when there is a lot of volatility, when they are changing, when they are going up and down wildly, people generally switch to gold. Because they take protection in gold. Let's keep our money in gold instead of these stock and bond markets. So gold's demand generally goes up whenever there is volatility in financial markets, right? So the demand for gold, will it go down? No. The demand for coal? No. Fertilizers? No. Oil? No. Domestic demand for these products will not go down. They are saying it is largely inelastic, which means we cannot inflate. Even if the economy is not going great, still the demand for them will continue to be there. That's what they are saying. That is why they use the word inelastic, not flexible. And elevated global prices for these will continue to escalate the import bill. And the prices for oil, fertilizers, coal and gold across the world, global prices are elevated, which means they are quite high, because of which our import bill will continue to escalate, which means go up. The import bill will continue to escalate because we are importing certain items. The prices of those items are going up every day, because of which import bill will go up further. The weakening rupee, which tumbled further to 79.37 vis-a-vis US dollar on Tuesday, will raise import costs further. Another sentence, very important sentence. Look at this. Let's say $1 equal to 70 rupees. This is case 1. In the case 2, $1 equal to 80 rupees. So what happened between case 1 and case 2? The value of dollar has gone up. Because for $1 we used to get 70 rupees. Now for $1 we are getting 80 rupees. Don't think that the value of rupee has gone up. The value of dollar has gone up. Because $1 which used to attract only 70 rupees, now it gets 80 rupees. Which means the value of rupee has gone down in this scenario. Now when we are importing $100 worth goods, assuming we are importing $100 worth goods, what would it cost in case 1? 100 into 70, which will be 7,000 rupees. In case 2, the same $100 would cost 100 into 80, which is 8,000 rupees. So whenever rupee falls, whenever the value of rupee falls, what happens? The import bill is going up. We used to pay 7,000 rupees for imports, now we are paying 8,000 rupees for import. Are you getting this? Are you getting this? Very, very important sentence. So the weakening rupee which weakened, tumbled, fell down further to 79.37 with respect to vis-a-vis, means in relation to or with respect to US dollar on Tuesday. It will further raise our import cost further. Analysts expect the rupee to scale the 82 to $8 mark. Analysts are expecting the rupee will go down till 82 rupees by October-December quarter and then recover from there. And the current account deficit to more than double to around 3% of GDP this year from 1.2% in 21-22. In 21-22, the current account deficit was 1.2% of GDP. Now the analysts are expecting the GDP current account deficit to more than double. It will become 3% of GDP. That's the expectation of analysts. That is the expectation of analysts. So CAD will widen further. Robust forex reserves notwithstanding. What is the meaning of notwithstanding? In spite of or despite. In spite of robust forex reserves, the persistent outflows of foreign capital from the financial markets have triggered concerns about the balance of payment situation. Very, very important sentence. I want you to pay full attention. Look at this. In the balance of payment account, we have two accounts. One is current account, the other one is capital account. So we looked at current account. Almost always it ends up in deficit. So it is generally negative. Capital account generally is positive. So it balances current account deficit. But here look at the sentence. The persistent outflows of foreign capital. What is the meaning of that? The foreign investors who invested in Indian markets, Indian stock markets, Indian bond markets, they are taking their money away. The money is going out. Why? In US, the Fed or United States Central Bank has increased interest rates. When US increases interest rates, it becomes attractive. So all these people, they move the money out of our country and try to invest in American bonds because they get more there, right? Because of which most of these foreign investors are taking the money out of our country. When the money goes out of our country, even in capital account, it will be a negative transaction. So current account is already negative. Even in capital account, we are seeing pressure. When you see this, the balance of payment will be quite negative, which means more money is going out of country than coming into the country. Clear? Is this clear to all of you? Pay full attention here. Let's assume $100 is moving out of the country and $80 is moving into the country. So we are getting $80, but $100 is going out, which means there is a deficit of $20. If we don't have money, how will you pay? How will you pay this $20? Think about it. When I am saying moving out of the country, pay attention. So let's say there is a company called IBM. I am taking an example. IBM has invested, let's say, 10 crores in India. Now IBM wants to move this money out of India to US. What happens? IBM will go to RBI, or foreign exchange market. In India, foreign exchange market is controlled by RBI, is regulated by RBI. It goes to RBI, take these 10 crore rupees, give me dollars. Are you getting it? IBM goes to RBI and says, take these 10 crore rupees and give me dollars. Let's assume RBI has zero money. RBI does not have any money, but since $80 have came in, now RBI has $80. So RBI has given equivalent worth of rupees to those people. So $80, RBI has $80. Now people like IBM are coming to RBI and they are asking for $100. They are giving rupees to RBI and they are asking for $100. But RBI only has $80. Then you have a shortage of $20. Where will you go? You have to take loan from IMF or World Bank. India faced similar situation in 1991. Balance of payment crisis. This is what India faced in 1991. When RBI doesn't have enough foreign exchange reserves, it leads to balance of payment crisis. But in today's world, RBI has lots of reserves. RBI maintains a lot of foreign exchange reserves. So even if there is a negative situation, we still have good amount of forex reserves. From this reserves, we will bridge this gap. That is what they are trying to say. What are they saying? Robust forex reserves notwithstanding. Notwithstanding means in spite of. In spite of or despite RBI having lot of foreign exchange reserves, the persistent outflows of foreign capital from financial markets have triggered concerns. Obviously, we are concerned. Every month, a lot of money is going out of country. And RBI's reserves are going down every month. So obviously, it is something of concern. Last week, government imposed a windfall tax on crude oil production that could help bridge concerns about the fiscal deficit. Very important sentence. What is the meaning of windfall tax? Government imposed something called windfall tax. Look at this. Domestic crude oil companies. In India also we have companies which produce crude oil. But this crude oil is not enough, because of which we import. Domestic crude oil companies are making lot of profits. Lots of profits. Why? Internationally, crude oil prices have gone up. In international market, crude oil prices have gone up. For them, the cost of production remains same, but since the prices have gone up a lot, domestic crude oil companies are making a lot of profit. We call it windfall profit. Why is the word windfall? Because it is not a regular one, it is a one time. It is a special situation, extraordinary situation. They are making hell lot of profit. And the government is now planning to tax this profit. And this tax is called windfall tax. This tax is called windfall tax. So that's what the meaning of windfall tax. So government imposed a windfall tax on crude oil production that could help. When government imposes tax, it gets a lot of money. With that money, we can bridge concerns about fiscal deficit. What is the meaning of fiscal deficit? The difference between the total income of the country and the expenditure of the country. If the expenditure is more than income, then we call it deficit. Fiscal deficit means India's expenses are more than income. Are you getting it? Fiscal deficit is expenses minus income. With windfall tax, your income is going up. When your income is going up, your fiscal deficit will obviously go down, right? The difference between income and expenditure will go down. So that is how we are addressing some concerns about fiscal deficit, because you are getting a lot of money here. It also placed restrictions on petroleum products exports and acknowledged that gold imports were hurting the current account by raising customs duties to 15% from 10.75%. Government also tried to do two more things. One, it tried to place restrictions on petroleum exports. You might think exports are good for the country. Why is the government trying to put restrictions on petroleum exports? Think about it. If you want to export a petroleum product, first you need to import crude oil. Government wants to reduce the imports. If you are exporting petroleum products, for that you need to import crude oil, right? So government wants to cut down that import of crude oil, because of which it is placing restrictions on exports of petroleum products. You need to understand this concept. And government also wants to cut down gold imports. How is it doing? It is doing it by raising customs duties. On gold import, custom duty has now gone up from 10.75% to 15%. But for every 100 rupees of gold that you are importing, you have to pay a customs duty of 15 rupees. Earlier it used to be 10.75%. Now it used to be 15%. Now it is 15%. They have increased it. This may end up hurting petroleum products further, while import duties may not dent India's unparalleled appetite for the yellow metal as much as hoped. Even though we have increased the import duty on gold, the imports of gold might not go down, because in India people have a craze for gold. And even if the prices go up, the demand may not go down. That's what they are saying. Unparalleled appetite. Appetite means that hungerness. I want gold, I want gold. Everybody wants gold. They don't look at prices. Right? You cannot dent it. Dent means damage. The import duty might not damage the appetite for gold, which means gold imports will continue to happen. But your decision to put restrictions will hurt exports. Coal imports, on the other hand, are expected to keep hitting record highs. We are importing coal also for generating electricity, because we are getting into monsoon season. Monsoon season will affect domestic output. Because of lot of rains, there will not be as much coal extraction from mines as expected. So coal imports will continue to go up. See, gold imports will continue to go up. Coal imports will continue to go up. So you are unable to reduce imports at all. So policy makers may have little room. Little means almost no room. Always remember, this word little is little tricky. Little means none, no, almost nothing. A little means some. When you say I have a little money, which means you have some money. When you say I have little money without using a, it means you don't have enough money. Not enough. That is the meaning. It's a negative. It always comes with negative connotation. Policy makers may have little room, which means almost no room, almost no space to maneuver. Maneuver means to act in a skillful manner out of this vicious cycle. Vicious means dangerous cycle. It's a dangerous cycle. The imports continue to go up and exports continue to go down. From this vicious cycle, it is not easy to come out, and policymakers don't have much room. But missteps, if you are taking wrong steps, those must be avoided. We have to avoid some wrong steps. Domestic inefficiencies hurting exports reviewed urgent. You have to look at means, you have to look at ways to increase our exports. Whatever inefficiency that we might be having today, which are hurting our exports, we have to review them urgently. That's all about today's editorial. I hope you have learned a lot in today's editorial. Put your reaction in comments. Take care. Bye.